Hello and Namaskar viewers, I am Sanjeev Pandya welcoming you to the Tax Time Show. This is the show gets you all the latest information that you really need to know when it comes to personal taxes as well as corporate taxes or any other taxes related matters, courtesy of Mr. Ajay Kumar, CPA and MBA with Sai CPA Services, a full-fledged accounting firm located right here in the state of New Jersey. Mr. Ajay is with us. Sir, welcome to the show. How are you?
I'm doing okay, Sanjeevji. How are you?
I am doing well too, and thank you so very much. And viewers, thank you for watching our show and thank you for your emails. As you've been sending a lot of emails asking us a lot of tax-related questions, so we appreciate that. Our email ID is taxtime@tvasiausa.com. It's good to have you again with us, Mr. Ajay Kumar. Today, I want to talk about something which I remember very clearly during my school and college days, mainly college days. As I studied accounting and the business and everything, we used to get projects from the professor, and then we had to prepare entire company's financials, and we had to show higher sales and net profit and everything, make look like company is very profitable. And after those projects were reviewed and everything, I remember professor used to say in the class that you should never cook the books. You should never add more numbers in the sales to show higher profit. I remember that very clearly. Although it's been going on for years in the corporate world, sometimes just to show higher profit for the partners, for the employees, or even for the stockholders, it's been going on, right? So today, I want to find out from you what are the methods that people use to cook the books and why they should not do it in order to prevent IRS audit.
Absolutely. So as you rightly said, these methods are not new. And just because the methods are not new, it's not just the general public. Even the IRS knows how typically the books are cooked, quote unquote, right? So IRS knows what to look out for. In this episode, we'll refer few general methods that IRS auditor will typically go out of their way to check if those are the methods that are used to cook the books.
Okay, so I will tell you some of the things that I know.
Please.
And then you gave me, your reply to it and little details on each method that I know. And in case if I miss something, you can add, one or two of you.
Absolutely.
The one I know is that improper timing of revenue recognition.
That's wonderful. That's a great start. So in improper timing of revenue recognition, what happens, sometimes you recognize more revenue sooner than when you should be recognizing. Take an example, Sanjeev. Yes. Say you signed a contract.
Yeah.
Let's say TV Asia just signed a contract for $10,000. The shooting hasn't started. So have you earned this money yet?
Not yet.
Probably not, right?
Yeah.
The money will start earning when you start putting the ad out.
Absolutely.
So do you have the right to recognize this revenue yet?
Probably don't have not. The right now.
Probably not,
yes.
Not yet. But since you have the money, you can put it in your book and call it as income. This inflates the income for the bank, for the shareholder, for the partner, as you rightly pointed out.
Yes.
This is called improper timing.
Yes.
The timing is sooner. On the flip side, if you choose to, you can push the revenue later. Let's say, for example, your taxable income is very high and you want to show lower taxes.
Yes.
So what you can say in theory, which you should not, and the IRS auditors will go out of their way to check for these things, you can say, well, I got $10,000, but this contract is for 3 months. So even though I have started that, 3 months are not over. I'm not going to recognize this revenue until the 3 months are over, which are going to be in January. What it does, it pushes the revenue from 2020 to 2021.
Yes.
So that's one method of managing the revenue from this year to that year. It can be brought in, meaning recognized sooner than what it should be. Principle is that the revenue should be recognized when realized and earned, meaning not only you have received the money, you have the right to the money, and you have earned this money. You have put in the ad out. Yes. You have delivered the service that you are supposed to deliver.
Okay.
That's when the revenue should be recognized.
That's improper timing.
Improper timing of revenue recognition.
Okay, good.
Is called.
What about fictitious revenue?
Yes, absolutely. Say fictitious, as the name says, the revenue is not real. Say, for example, what IRS is looking out for, and the common example, the typical scenario that IRS looks out for, when you have same vendor and the same customer.
Same vendor and the same customer.
So what happens, let's say I'm selling my Sai CPA services. I say I bought $100,000 worth of services from Sanjeev, and then I'm subcontracting this service to have done by somebody else, and that person is also Sanjeev. Meaning it's rotation of money. So the principle is I'm collecting money from here and giving money to this person. There is no real service, there is no real product over here. I'm just rotating the money between three parties.
On the paper.
On the paper. What it does, it inflates the revenue.
Yes.
On the revenue side. On the expense side, depending on if I pay more to the vendor or less to the vendor, I can manage the profit. I can recognize $100,000 of revenue. Then I say, you know what, I'm growing company. I have to expand the revenue. What does it mean? I have to subcontract this work for $101,000. What I just did is all paper revenue. It's all rotation.
Correct.
But I just recognized a loss of $1,000. That's called fictitious revenue. There is no real revenue.
No, absolutely, I got that. But for a company where they have, let's say, hundreds of thousands of transactions during the year, how are they going to find out that on what month, what order number had this fictitious revenue thing going on?
That's wonderful. That's a great question, right? Let's say you have hundreds of thousands of transactions every year, right?
Correct.
So every month, let's assume for the sake of this example, you have $1 million worth of transaction. If there's a fictitious revenue for $100, is it really worth for the company to run the risk of having $100 of fictitious revenue?
No.
Probably not. So if the auditor is not able to find $100, it doesn't hurt the company, it doesn't hurt the bank, it doesn't hurt the public, the shareholder here. But if in this example, your monthly revenue is $1 million, if the fictitious transactions are $500,000, $600,000, it wouldn't be too hard for the auditor to find out if the volume of the fictitious transaction or the magnitude of the fictitious transaction is just too high.
Correct.
So if it's too small, it's not worth for the company, it's not worth for the auditor, it's not hurting anybody. And why would you do it if it's not worth it? If it's large enough to make a difference for the company, then it becomes large enough for the auditor to find out.
Then it sticks out like a sore eye, and they
it
will
does.
definitely point.
Absolutely.
But either way, whether it's a small or large, should not do it because it's not the right way to do it.
As I said, IRS auditors are especially trained for these matters to see, and the telltale sign is when you see the vendor name and the customer name as the same name.
Correct.
It's a simple rotation.
Okay, with that note, before we go into the break, quickly, there's a one more method also that I want to point out. It's called related third-party transaction. Here you just mentioned transaction between the same parties. Sanjeev here, Sanjeev there. But related third-party transaction, how does that work and how the books can be cooked by that method?
Absolutely. So in our second example, when we said the fictitious revenue, typically there are three parties. One is the vendor, one is the customer. Revenue comes from the customer and the order goes to the vendor. Right? That's how this triangle is formed.
Correct.
So without actually services being transferred, only the money is being exchanged on the paper. That's fictitious revenue.
Yes.
But in third party transaction, what happens, you have your brother, your sister, your wife, your friend, a related party, having a company where you have these transactions, large transactions going back and forth. Okay. Or let's say you need to earn a lot of revenue. To the shareholders, you must show 10% growth in order to maintain the share value. You create your own company that's owned by your wife.
Your family member.
Your family member, a related party.
Or you may have many consultants on a board just there with their names on them.
It's possible.
Yes.
The idea is you have a related party, meaning you have certain influence on this party, directly or indirectly, to create the order.
Right.
Can you please send me the order for $1 million? You can cancel it later. I'm telling you
I see. Yes.
to give me the order because I know you. You are a related party. And then I can book it, show it in the revenue or show it in the sales order list, only knowing full well it's not a real order.
But that affects on a third party's books as well.
Oh, of course.
Yeah.
Of course. But
So
that company, you own it. And it doesn't have to be a public company.
Yes.
Meaning a public company has the right to deal with any company, public or private, right?
All right, so these are some of the methods we discussed, viewers, but I can assure you there are more coming your way in this episode where we're going to talk about do not cook the books. That means the business books. More coming after these messages. Please don't go anywhere.